I alerted you. Before this week is over, 3 separate signals are set to collide. A senator standing inside Fort Knox, staring at ounces of gold most Americans will never see. A CPI report landing tomorrow morning, one number capable of moving billions in the metals market within seconds. And a paper market on COMEX so overloaded that a single day's trading now exceeds a third of everything the world's silver mines produce in an entire year. These are not separate stories. They are 3 pressure points, converging on the same fragile system. And by the end of this analysis, you will understand exactly why serious investors are no longer treating this as background noise. Stay with this, because what happens next could not be more urgent. Welcome to Currency Arc Insight, the channel where serious investors and business decision makers come to separate signal from noise in the gold and silver markets. Before we go further, subscribe now so this kind of economic warning reaches you before the headlines catch up, and drop a comment telling us which city or country you're watching from tonight. Deep beneath the hills of Kentucky, inside a vault most Americans will never see with their own eyes, sits one of the largest concentrations of gold on the planet. This week, that vault became the center of a story that reaches far beyond politics. A sitting United States senator walked into Fort Knox to view the nation's gold reserves firsthand, a visit that quickly drew both attention and controversy. Critics labeled it an eyeball audit, questioning whether a few hours underground could verify the full scope of America's holdings. But for serious observers of the monetary system, the details of the visit were never the real story. The real story is why anyone felt the need to check in the first place. For decades, the United States has operated on a simple assumption, that the dollar in a person's wallet holds stable value, backed by the strength of the economy and the credibility of its institutions. That assumption has quietly eroded. According to the senator's own remarks following the visit, the dollar has lost more than 85% of its purchasing power since 1971, the year the United States formally severed the currency's direct link to gold. What once required a single dollar now requires several times that amount to purchase the same goods and services. This is not a temporary inconvenience. It is a 5-decade trend, and it accelerates each time government spending outpaces revenue. To understand why this matters now, it helps to revisit what changed in 1971. Before that year, the dollar operated under a system where its value was tied to a fixed quantity of gold, a structure that placed a natural ceiling on how much currency could be created. When that link was removed, the constraint disappeared with it. Currency could be issued in response to political and economic pressure rather than backed by a finite physical asset. The result has been a persistent decline in the dollar's real value, offset for years by the confidence that the system would remain stable enough to absorb it. That confidence is now being tested. The national debt has been expanding at a pace that outstrips historical norms, with deficits running near $2 trillion annually in recent years. A meaningful portion of that debt is financed through mechanisms that ultimately increase the money supply, a process that economists broadly recognize as inflationary. The public often experiences this not as an abstract statistic, but as a tangible reality at the grocery store, at the gas pumps, and on monthly bills. Prices have risen by roughly 25% over the past 5 years alone, a shift many households have felt more sharply than any government report conveys. This is the backdrop against which the Fort Knox visit should be understood. When a lawmaker feels compelled to personally verify the nation's gold holdings, it signals something beyond routine oversight. It reflects a broader unease about trust in the monetary system itself, a system increasingly dependent on confidence rather than tangible backing. Gold, by contrast, carries no counterparty risk. It cannot be created by policy decision, and its physical scarcity has remained constant across centuries of currency experiments that came and went. This is precisely why gold's role in the financial conversation has shifted in recent years. It is no longer confined to niche investment circles or economic history discussions. Central banks, sovereign nations, and increasingly private investors are treating gold as a hedge against the very system that replaced it as the dollar's foundation. The Fort Knox visit did not create this dynamic. It simply put a spotlight on a story that has been building quietly for 50 years, one measured not in headlines, but in eroding purchasing power. What comes next in this analysis moves from the symbolic to the structural, examining how pressure is building not just in the value of the currency itself, but in the very market where physical metal changes hands. That pressure is already visible in the numbers, and it points to a supply and demand imbalance that few investors are watching closely enough. While the conversation around gold often centers on trust and currency debasement, silver tells a different but equally urgent story, one rooted not in monetary symbolism, but in the basic mechanics of supply and demand. That story came into sharp focus recently when a single trading session on COMEX saw 327 million ounces of paper silver change hands. To put that figure in perspective, the entire global mining sector produces roughly 800 million ounces of physical silver in an average year. In one day, contract activity on paper exceeded a third of what it takes the world's mining industry 12 months to extract from the ground. This gap between paper trading volume and physical production is not a new phenomenon, but its scale has become increasingly difficult to ignore. Futures and derivatives markets have long allowed silver to be bought and sold in volumes far exceeding what physically exists, a structure that has historically kept prices more stable than the underlying physical market might otherwise dictate. But stability built on paper has limits, and those limits become more visible as the gap between contract volume and available physical metal continues to widen. The deeper issue lies beneath the surface of any single day's trading. For roughly 2 decades, silver mining companies fought to remain profitable during a prolonged period of depressed prices. Many turned to a practice known as high grading, extracting only the richest, most concentrated ore in an effort to preserve margins, rather than mining more broadly and sustainably. The approach kept operations afloat in the short term, but it came at a long-term cost. Much of the easily accessible, high-grade silver has already been extracted, leaving future production increasingly dependent on lower-grade, more expensive deposits. Compounding this constraint, a number of formerly silver-focused mining companies shifted their strategic priorities toward gold over the past several years, seeking more stable margins in a metal that had outperformed silver for extended stretches. This diversification, while rational from a corporate survival standpoint, has further narrowed the pool of dedicated silver production. The combined effect is a supply base that is structurally less capable of responding quickly to rising demand, regardless of what price signals suggest should happen. On the demand side, the pressure is intensifying from multiple directions simultaneously. Silver's industrial applications continue to expand, driven by its use in electronics, solar technology, and increasingly specialized fields such as nuclear fusion research, where its unique properties are being applied to processes like isotope separation. At the same time, investment demand for physical silver, from coins and bars to exchange-traded products, has remained resilient even during periods of price volatility. Unlike gold, which draws demand primarily from monetary and reserve considerations, silver sits at the intersection of industrial necessity and monetary hedge, a dual role that makes its supply constraints particularly consequential. This is the environment in which a single day's paper trading volume becomes more than a statistic. It becomes a signal of just how much leverage exists in a market where the physical metal underlying every contract is becoming structurally harder to produce at scale. Markets built on this kind of imbalance do not necessarily break in predictable, orderly ways. When paper positions vastly outnumber the physical metal available to settle them, the system relies on the assumption that large numbers of contract holders will never simultaneously demand physical delivery. That assumption is held for years. Whether it continues to hold as supply tightens further is a question serious market participants are increasingly unwilling to ignore. Taken together with the currency erosion outlined in the previous section, a pattern begins to emerge. Confidence in paper claims, whether they represent currency or metal, depends on a structural stability that appears increasingly strained. The next piece of this analysis turns to a single data point capable of moving this entire picture within minutes, a consumer price index release that will test, in real time, how these long-term pressures interact with short-term market psychology. Against the backdrop of currency erosion and a tightening physical silver market, a single economic release now stands ready to test how these long-term pressures interact with short-term market behavior. The Consumer Price Index, the government's primary measure of inflation, is set for release, and its outcome carries the potential to move billions of dollars in the gold and silver markets within seconds of publication. For an audience focused on long-term positioning, understanding why this single data point commands such influence and why its short-term impact should not be confused with the larger trend is essential. Market expectations heading into their release center on an annual inflation figure near 3.4%. This number matters because it feeds directly into decisions made by the Federal Reserve regarding interest rates. When inflation data comes in at or below expectations, it typically reduces pressure on the central bank to maintain higher interest rates, a dynamic that tends to support gold and silver prices. Lower rates reduce the opportunity cost of holding non-yielding assets like precious metals, making them comparatively more attractive relative to interest-bearing alternatives, such as bonds or savings instruments. The opposite scenario carries real short-term risk. Should the inflation reading come in hotter than expected, it would likely reinforce expectations that interest rates need to remain elevated for longer, an outcome that historically places short-term downward pressure on metals prices as capital shifts toward yield-bearing assets. Some market participants have expressed skepticism about the reliability of official inflation figures altogether, a debate that speaks to a broader erosion of trust in institutional data, echoing the same confidence concerns raised by the Fort Knox visit discussed earlier in this analysis. Whether or not that skepticism is warranted, the market's reaction to the headline number remains immediate and measurable, regardless of any debate about its underlying accuracy. This is precisely where discipline becomes critical for serious investors. A single data release, however significant in the moment, represents short-term noise layered on top of a multi-year structural story. The pressures outlined in the preceding analysis, a dollar that has lost the majority of its purchasing power since 1971, a silver market where paper trading volume dramatically outpaces physical production, do not resolve or reverse based on 1 month's inflation print. Yet market psychology often treats such releases as far more consequential than they are in the broader arc of a multi-year trend. History offers a useful lesson here. Investors who allow short-term volatility to dictate long-term decisions frequently find themselves making costly errors, selling into weakness driven by a single data point, only to watch the underlying structural trend reassert itself in the following weeks or months. The discipline required to separate a single day's price action from the multi-decade currency and supply dynamics discussed throughout this analysis is precisely what distinguishes strategic positioning from reactive trading. It is also worth noting what this single release does not change. It does not alter the structural silver supply constraints created by 2 decades of high grading and mining sector diversification. It does not reverse the dollar's documented decline in purchasing power since the gold standard's end. It does not undo the accumulation of paper contracts, trading at volumes far exceeding available physical metal. These forces operate on a timeline measured in years and decades, not in the minutes following a single government data release. What the CPI release does offer is a useful test of market sentiment in real time, a window into how quickly capital moves when official data intersects with an already fragile system. For decision makers watching this space, the appropriate response is not to react impulsively to a single number, but to use the volatility as a data point within a much larger framework, one that continues to point towards structural pressure building beneath the surface of daily price movements. This is where the analysis shifts from market mechanics to institutional behavior. Beyond individual data releases, a quieter transformation is underway in how major financial institutions and regulators are beginning to treat gold itself, a shift in infrastructure that may prove more consequential than any single economic report. Beyond the immediate volatility of data releases and the structural pressures already outlined, a quieter but potentially more consequential shift is taking shape within the financial system itself. It is not measured in a single day's price movement, but in the infrastructure being built around gold, infrastructure that could reshape how the metal is bought, held, and used for years to come. Institutional positioning offers the first indication of this shift. Major financial institutions have begun signaling clear conviction in gold's trajectory. One of the largest banking institutions in the country has publicly stated that it views $4,000 per ounce as a firm floor for gold, a threshold below which the bank does not expect prices to fall in any sustained way. That same institution's chief executive has gone further, projecting gold could reach $5,000 per ounce by the fourth quarter of this year. These are not speculative retail predictions. They are positions taken by institutions with direct access to capital flows, central bank behavior, and macroeconomic data unavailable to the general public. This institutional conviction is visible in options market activity as well. Analysts tracking derivatives data have noted a significant increase in call option purchases on gold-related exchange-traded funds, with buying volume far outweighing bearish put positioning. Similar activity has appeared in gold mining sector funds. Call options represent bets that prices will rise, and when institutional capital flows disproportionately into bullish positioning across both the metal and the companies that produce it, it signals a level of conviction that extends beyond short-term trading strategy into longer-term portfolio allocation. Central bank behavior reinforces this pattern. Gold purchases by central banks around the world have remained elevated for several consecutive years, a trend that predates recent price volatility and reflects a deliberate strategic shift in reserve composition. Nations that once held the majority of their reserves in foreign currencies, particularly the dollar, have been steadily increasing their gold allocations, a move widely interpreted as a hedge against currency risk and geopolitical uncertainty. This is not a retail-driven trend. It is a sovereign-level recalibration of what constitutes a safe reserve asset. Perhaps the most structurally significant development, however, is emerging not from traditional finance, but from the intersection of gold and digital infrastructure. Regulatory bodies, including the United Kingdom's Financial Conduct Authority, are reportedly working with major banks and bullion market participants to develop a framework for tokenized gold, digital tokens backed one-to-one by physical metal held in secure vaults. Unlike purely digital representations of value, this model requires actual physical gold to exist in reserve before a corresponding token can be issued, creating a direct link between digital transaction infrastructure and physical scarcity. This is not a theoretical concept. Tether, a company already prominent in digital asset markets, has emerged as one of the largest buyers of physical gold over recent months, ranking among the top 5 global purchasers during the most recent quarter, acquiring gold specifically to back its tokenized gold product. This kind of demand did not exist at this scale even a few years ago, and it represents an entirely new category of buyer entering the physical gold market, one driven by financial infrastructure needs rather than traditional investment or reserve strategy. The significance of this shift becomes clearer when viewed through a historical lens. When gold and silver exchange traded funds were first introduced decades ago, they created an entirely new channel of demand by requiring physical metal backing for every share issued, a structural requirement that pulled substantial quantities of metal out of circulation and into vault storage. Tokenized gold, if it develops along a similar trajectory, could create a comparable demand channel, one built on the same principle. No token without verified physical backing. None of this diminishes the role of direct physical ownership, which remains central to how many investors and institutions approach precious metals. But it does suggest that the total pool of demand for physical gold is expanding into categories that did not exist in previous market cycles. Infrastructure, once built, tends to create sustained demand rather than temporary spikes, a distinction that matters greatly for anyone evaluating the difference between a short-term rally and a structural shift in how gold is held and used. With institutional conviction, central bank accumulation, and emerging digital infrastructure all converging, the final piece of this analysis turns to how these forces intersect with a broader macroeconomic picture, one defined by unsustainable debt levels and historically stretched valuations across traditional financial markets. Each of the forces examined throughout this analysis, the erosion of the dollar's purchasing power, the structural supply constraints building in the silver market, the short-term volatility introduced by data releases like the Consumer Price Index, and the emerging institutional and digital infrastructure being built around gold, does not exist in isolation. These are not four separate stories. They are four expressions of a single underlying condition, and understanding how they converge is what separates reactive market participants from those making informed strategic decisions. At the center of this convergence sits the United States national debt, a figure that has been doubling roughly every 10 years, regardless of which political party holds office. This is a critical distinction worth emphasizing. The scale of this debt growth is not attributable to any single administration or policy agenda. It reflects a structural pattern in government spending and deficit financing that has persisted across multiple decades and multiple political cycles, suggesting a systemic issue rather than a partisan one. As debt continues to compound, the mechanisms used to service it, including money creation that contributes to inflation, place ongoing pressure on the currency's value, reinforcing the dynamic examined in the first part of this analysis. This debt trajectory does not exist in a vacuum. It intersects directly with historically stretched valuations across traditional equity markets. The dividend yield on the S&P 500, a measure of the return investors receive relative to stock prices, has fallen to just over 1%, the lowest level on record. A low dividend yield indicates that stock prices have risen dramatically relative to the income they generate, a sign that valuations have become disconnected from traditional measures of return. Or separately, a widely followed valuation metric known as the cyclically adjusted price-to-earnings ratio, which accounts for a 10-year average of corporate earnings adjusted for inflation, currently sits at its second highest level in recorded history, surpassed only by the peak of the late 1990s technology bubble. These are not minor statistical footnotes. They represent measurable evidence that traditional equity markets are priced at levels historically associated with periods of significant risk, levels that have, in prior instances, preceded substantial corrections. This does not guarantee an imminent crash, and history shows that elevated valuations can persist longer than many anticipate. But it does establish a meaningful backdrop against which gold and silver's structural demand story becomes more significant, not less. Global capital flows offer further confirmation of this shifting landscape. In China, a prolonged real estate downturn has stripped roughly a quarter of the value from what was once the primary store of household wealth for hundreds of millions of people. With property values declining, equity markets viewed with long-standing distrust, and cryptocurrency access restricted by regulation, Chinese households and institutions have increasingly directed capital toward gold and silver, assets with a deep cultural and historical association with stored value in that region. This is not a temporary reallocation. It reflects a structural shift in where a significant portion of the world's population chooses to preserve wealth when traditional options appear compromised. Taken together, these four dynamics, currency erosion, physical supply constraints, institutional and digital infrastructure development, and a fragile backdrop of unsustainable debt and stretched valuations, do not point toward a single dramatic event on a specific date. They point toward a sustained structural shift already underway, one that has been building for years and shows no clear sign of reversing in the near term. For business decision makers and serious investors, the appropriate response to this convergence is neither panic nor complacency. It is preparation grounded in an understanding of these structural forces rather than reaction to any single headline or data point. Markets that are driven by short-term sentiment often obscure the longer, more consequential trends unfolding beneath the surface. This analysis has attempted to bring those trends into clear focus, not to predict a specific outcome, but to equip those responsible for protecting capital with the context needed to make informed decisions in the months and years ahead. The signals examined here, from Fort Knox to COMEX, from a single CPI release to the infrastructure now being built around gold itself, all point toward the same conclusion. The system that has defined the past 50 years is under measurable strain, and those paying attention now will be far better positioned than those who wait for the headlines to catch up.